$700 billion. That's how much the world spent on AI last year. And according to Goldman Sachs chief economist, it added, and I quote, basically zero to U.S. GDP. Most of that money went to chips and servers manufactured in Taiwan and Korea. It boosted their GDP, not America's. But here's what's strange. While the macro numbers show nothing, individual companies are reporting billions in savings. JP Morgan says its $2 billion AI investment has already paid for itself. A logistics company cut quote times from hours to 32 seconds. A retailer reduced stockouts by 25%. So what's going on? Why does AI show zero at the economy level but massive returns at the company level? The answer is Phase 3, and today I'll show you exactly how to find the companies that are quietly winning, using 5 data-driven lenses that Wall Street is only beginning to understand. In our last video, we explained the AI productivity J-curve. Let me quickly recap. Phase 1 was infrastructure, the picks and shovels, NVIDIA, cloud providers, data centers. That trade is largely done. Phase 2 was platforms, the model builders, OpenAI, Anthropic, the foundation model race. Investors poured in, valuations soared. Phase 3 is where it gets interesting. This is the productivity phase. Non-tech companies using AI to generate real profits. Not building AI, using it. And the data says the gap between winners and losers is enormous. BCG surveyed thousands of companies and found that only 5% are what they call future-built for AI. But that 5%? They deliver 1.7 times the revenue growth, 1.6 times the EBIT margins, and 3.6 times the total shareholder returns compared to the bottom 60%, who report essentially zero ROI from AI. Goldman Sachs calls investing in Phase 3 beneficiaries the most important trade of 2026. They even built a dedicated portfolio, the GSXUPROD basket, targeting non-tech companies where AI will drive the biggest earnings improvements. But here's the problem. How do you find these companies? Goldman uses one formula. I think you need 5. Goldman's GSXUPROD portfolio uses a straightforward formula. Find companies with high labor costs as a percentage of revenue and high exposure to AI automation. The logic is simple. More labor, more savings from AI. By this formula, the top beneficiaries are tax preparation, staffing agencies, food service, and consulting. And Goldman's #1 pick? A tax preparation company trading at just 6 times earnings. Sounds compelling, but there's a trap. If AI can do your job entirely, then AI doesn't make your company more efficient. It makes your company obsolete. Tax preparation is rules-based, repetitive, and data-intensive. That's not a company that benefits from AI. That's a company that gets replaced by AI. The IRS is already offering free AI-assisted filing. ChatGPT can handle a standard tax return. This is the difference between AI as a tool and AI as a replacement. And the labor cost formula alone can't tell them apart. Here's another trap. A freight brokerage might show a 5% operating margin on total revenue, which looks like massive margin leverage. But most of that revenue is pass-through transportation costs. The actual margin on their real revenue is 30%. The 5% is an illusion. So labor cost is necessary but not sufficient. You need more lenses. Here are the 5 lenses I use. 2 are quantitative. You can measure them from public filings. 3 require judgment, which is why analysis matters. Lens 1, margin leverage. This is the most powerful and most measurable. The formula is simple. Take the AI-driven margin improvement and divide it by the company's current operating margin. That gives you the earnings growth rate. Bank of America projects AI will improve operating margins by about 2 percentage points across industries over the next 5 years. Let's apply that. A grocery chain operating at 3% margin gains 2 points. That's a 67% increase in earnings. An airline at 8% margin, earnings up 25%. A bank at 20%, only 10%. Same 2 points of improvement, vastly different earnings impact. This is measurable from any 10K filing. Just look up the operating margin. But watch out for broker and agency business models. Always use net revenue margin, not total revenue margin. If revenue includes pass-through costs, the margin is artificially low and the leverage is artificially high. Lens 2. Labor cost exposure. This is Goldman's formula, and it works, as long as you combine it with the other lenses. Look at SG&A as a percentage of revenue, or employee costs if disclosed separately. Healthcare runs at 56% labor costs, professional services at 25 to 40, manufacturing at 10 to 25. Higher labor cost generally means more potential for AI automation savings. But remember the labor cost trap. If AI replaces the entire service, high labor cost becomes a death sentence, not a benefit. The key question isn't just how much labor, it's what happens to the business when that labor is automated. If the answer is, we serve customers better and faster, that's phase 3. If the answer is, customers no longer need us, that's disruption. Lens 3. Data moat. This is where it gets harder to measure but more important. An NBER study by Eisfeldt and colleagues found that the single best predictor of which companies benefit from AI is not labor cost alone. It's the interaction between labor exposure and data assets. Companies with both high labor exposure and strong proprietary data saw significantly higher stock returns. The logic is intuitive. If you and your competitor both adopt the same AI tools, neither gains an edge. AI only creates a durable advantage when it's trained on data that your competitors don't have. Think about it. An insurance company with 15 years of real-time driving data from millions of vehicles can price risk better than any competitor starting from scratch. A bank with decades of transaction records can detect fraud patterns that a new entrant can't replicate. A farm equipment maker with proprietary agronomic data from millions of acres can optimize yields in ways nobody else can. But here's the critical caveat from Andreessen Horowitz. Generic data collection rarely creates a moat. The cost of gathering unique data goes up while the marginal value goes down. Only walled gardens of domain-specific, hard-to-replicate data create real defensibility. So the question to ask is, what data does this company generate as a natural byproduct of its operations that nobody else can get? This lens is hard to quantify. There's no standard metric for data uniqueness. You have to read earnings calls, understand the business model, and use judgment. Lens 4. Execution quality. BCG's data shows that in the same industry, with the same labor costs, the gap between AI leaders and laggards is 3.6 times in shareholder returns. The difference? Management. So how do you evaluate this from the outside? Look for one thing: hard numbers on earnings calls. When a CEO says, "We saved 360,000 legal work hours with AI," or "Our AI agents processed 3 million tasks and cut quote time from hours to 32 seconds," that's real. When a CEO says, "We are actively leveraging AI across our organization," that's a press release. Of the 306 S&P 500 companies that mentioned AI on earnings calls last quarter, a record, only a fraction backed it up with specific dollar figures or productivity metrics. And here's a data point that matters. Companies that partner with established AI vendors succeed 67% of the time. Companies that try to build AI internally? 22%. The implementation approach is as important as the technology itself. Digitally mature companies achieve 10.3 times ROI from AI versus 3.7 times for companies with poor digital integration. That's a 2.8 times difference based purely on readiness. The fifth and final lens, revenue AI versus cost AI. Most companies use AI to cut costs, replace labor, automate processes, reduce errors. That's valuable, but it's a one-time margin improvement. Once you've cut the cost, it's done. Revenue AI is different. When a payments company uses AI to offer fraud detection as a paid service to banks, and that service grows 23% year over year, that's compounding revenue. When a retailer uses AI for dynamic pricing and personalized advertising, generating a 46% jump in ad revenue, that's a new business line, not a cost cut. The distinction matters for long-term investors. Cost AI gives you a one-time step up in margins. Revenue AI gives you a growth engine. Ask yourself, is this company using AI to do the same thing cheaper or to do something new that generates revenue? The best Phase 3 winners do both, but the revenue side is what compounds. This lens is hard to measure because companies don't separately report AI-driven revenue. You have to listen to earnings calls, read the 10K, and judge for yourself which category fits. Let's bring it all together. Phase 3 of the AI revolution is here. The infrastructure has been built. The platforms exist. Now the question is, which companies turn AI into actual earnings? To find them, use these 5 lenses. First, margin leverage. Low-margin businesses get exponentially more earnings growth from the same AI improvement. You can measure this directly from any public filing. Second, labor cost exposure. High labor costs mean more room for AI automation. But make sure AI enhances the business rather than eliminates it. Third, data moat. The NBER research is clear. Labor exposure alone isn't enough. Companies need proprietary, hard-to-replicate data to create a lasting AI advantage. Fourth, execution quality. Same industry, same opportunity, but 3.6 times difference in returns. Look for hard numbers, not press releases, and check whether they're partnering with vendors or building alone. Fifth, revenue AI versus cost AI. Cost cutting is valuable but finite. Revenue generation compounds. The best Phase 3 winners create new business lines powered by AI. 2 of these lenses are fully measurable from public data. 3 require analysis and judgment. That's what makes investing hard and what makes it rewarding. No single lens is sufficient. A company with high labor costs but no data moat will see its AI gains competed away. A company with a great data moat but high margins won't see the earnings leverage. You need the full picture. If you found this framework useful, subscribe for more data-driven analysis.